Okay. So yeah, Cut and Kyle, appreciate you guys being here. Excited to have you both, and I've known you guys for a while, and major players in the Houston multifamily space, and yeah, just would love to kind of would love to introduction from you guys, and then we can kind of hop into things. And Hayden, is there anything else that you could think of that we should mention?
Um, no, maybe just some expectations on what we're going to talk about. So obviously, Kyle and Cutt are in the Houston market with Berkadia, and we'll let them do introductions for you guys. But they're going to talk about kind of the trends they've seen at the ground level here in Houston. In the market, these guys have a lot of deals going. So they've got a lot of great expertise, and just to kind of give you guys a little bit more insights on where the broader market and then Houston specifically is headed. So with that, I'll turn it over. Cut, if you want to introduce yourself first.
Yeah, for sure. Thanks for the introduction. It's a pleasure to be here. Uh, been with Berkadia now for, man, I feel like, yeah, I guess since spring of 2010. Always been focused on debt and equity. Uh, we uh, we tend to spend more time in the capitalization of multifamily assets. Um, Even though that, we're domiciled here in Houston, we're pretty unique in the fact that, a lot of what we do is outside of the market. It's a factor of us having clients on both coasts. So we spend a lot of time outside of Texas as well. Um, as it relates to Berkadia specifically, we are one of the largest multifamily lenders in the country. Year over year, I think we're probably, as far as Fannie, Freddie, and HUD combined, we tend to be the number one lender across those facets of multifamily financings. And for Hayden and Dustin, we're seeing a little bit of all of it right now. And we're I can tell you that, and I think anybody that spent time on acquisitions, uh, half of it's practice and half of it might relate to a closing at some point. So everybody's kind of feeling the struggles of uncertainty. It seems to be a headline right now. I feel like, as soon as we kind of begin to get our footing, we'll have some report that comes out. The latest being, obviously the jobs report and the revision and whatnot, and it kind of set us back, a couple of months. But with that said, I'll turn it over to Kyle, and he can introduce himself.
Dustin, Hayden, thanks for having us on. Always a joy to work with you guys. I'm Kyle Whitney. I'm on the investment sales side with Berkadia in the Houston office. We have a team of 6 brokers here, and unlike Cutt, who works throughout the country on debt and equity originations, we solely focus on the Houston MSA. So we've got close to 800,000 units here. That keeps us busy. And we're pretty active in the market, as Dustin and Hayden alluded to. Currently have about plus or minus 20 deals in the market, ranging from Hanover River Oaks, which is a high-rise asset here in urban Houston, to foreclosure deals, 70s construction. So our team really kind of sees everything up and down the asset class spectrum. So happy to share our thoughts.
Awesome. Yeah, appreciate it, guys. Happy to. I'm sure there's plenty of questions and all that. But yeah, would love to kind of hear. Maybe start with you, Kyle. What you're seeing. More specifically in the market. I guess maybe where you're seeing maybe some foreclosures and things like that. If there's any common themes there. But yeah, I would love to just, of the deals you guys have in the market, what do those look like? Are they in trouble? Have they owned for a long time? I'm sure, it's a mixture of everything, but would love to get a little more insight there.
For sure. So it's a little bit of a haves and have not in the market right now. I mean, I think what a lot of, capital providers and operators kind of thought, 12, 18 months ago is we saw a big debt maturity wave coming up, 24, 25, 26. Thought we saw a lot of distress in the financials and the underwriting and the BOVs we were providing. But ultimately, what we're seeing play out is kind of a slow deleveraging of the real estate market, of multifamily assets. And so, lenders have been relatively, flexible with their terms and how they're able to work with borrowers. And this has kind of delayed kind of what everyone's kind of waiting for. So from a foreclosure standpoint, it's starting to happen more often, as lenders are starting to rip the Band-Aid. There is a lot of distress or quote unquote opportunistic capital raised right now for that. But contrary to that side of the business and the market, a lot of capital has shifted to similar, to kind of where you guys have played for a number of years now, and that's the 90s and 2000s and newer, where there is a lot of value add and core plus money out there chasing those types of assets. So I think, kind of the biggest shift we've seen with that happening is what has happened with cap rates in the Class B and C space. BC being anywhere from 60s to 80s construction. I'd say, 6 to 8 months ago, I would peg, in place cap rates, and so T3 income, and then subtracting underwritten expenses, tax and insurance adjusted, to get to an NOI. But those cap rates were probably, high 5s to a 6, probably 12 months ago for well-located, BC product. Today we're seeing 6.5 to 7, where the 2000s and newer space is still trading probably in the 5 to 5.5 range, depending on vintage, location, and factors like that. So the spread on cap rates with the asset classes is historically how apartments have traded, and I think it's taken some time to get back there, but it sounds like and feels like we're back to that point where there's an obvious spread in your yields going in, for your newer deals and your older assets that require a little more capex and attention.
Right. Yeah. And I think to your point, Kyle, I think that's something that we didn't see a few years ago. So it's probably a healthy thing for the market in general. I'd like to toss it over to Cutt because Kyle, you talked about this a little bit, about lenders being a little bit more flexible with some of the borrowers, and so I'd be curious, Cutt, from your seat, is there any particular reason why maybe they're more willing to do that? Is it situation by situation, or is it, hey, do they really believe kicking the can a little bit longer is going to lead to much better, more favorable conditions?
I do think that is, up until this point, we have seen a lot of kicking the can down the road. And I think, just based on the amount of BOV activity that Kyle and his team is working through right now is a pretty good indication that most lenders are kind of getting to the end of that road, right? Everybody has access to real-time information. They know where the values are. They understand groups' abilities to bring in additional equity to kind of right the ship. And I think with all of that information at hand, I think now we're starting to see lending institutions really start to force, borrowers to make a decision, whether that's obviously to, maybe it's a cash and refinance situation, or they might have to sell, at a discount. So I think we're starting to see the end of that at this point. I think, and with that, there's always a dislocation, right? Whenever we issue a BOV, and I think, Kyle, what's your process typically from BOV to being awarded a deal? That sometimes can span 3 weeks, in some cases 4 weeks. And in this environment, we're seeing there's so much, it's moving so fast, and due to the uncertainty, we just continue to see this, even with an expectation on BOV, we continue to see dislocation between buyers and sellers, even whenever we're calling for offers, and everybody's pretty astute to how the market's moved. So, deals are still pretty tough to pull together. I think that, the deals that are coming together it's going to, as far as the equity snapshot goes, it'll be a combination of, discretionary funds, whole funds. The retail syndication model, I think of late is starting to get some traction again. So that's good to see. And as far as, some of the debt goes, I mean, it's been very agency heavy. 5-year fixed rate money has probably been, I would say, the premier debt execution. But as of within the last 30 days, we're seeing a significant uptick in the request for floating rate money, whether it's from banks or debt funds or some life companies that have the ability to float.
Got it. Kyle, I was curious, as far as, the number of bids that you're seeing, and the groups that are bidding and being awarded and all that. I'm sure it's all across the board. But what kind of offer counts are you seeing on different types of deals? And I guess who's a player in the market and all that, and just curious what that looks like, and if you're seeing institutional groups come in or more local players.
Yeah, and I can kind of walk back to starting January and kind of what we're seeing live. But I'll say from January to Liberation Day, we saw a bunch of momentum in the market. We had a 2016 vintage deal in Conroe we went to the market with. It looks like a lot of assets that you guys in your portfolio. We had 40 offers, blew through our pricing guidance, lots of movement in the best and final. And then, that was mostly private guys, private capital. And then on the heels of that, we brought out a more urban 2000s vintage with a huge value add component, really what a lot of these institutions and larger players have big billion-dollar funds raised for. And we had 30 offers on a $90 million asset called Marcelo Mora Heights, and 4 out of our 5 best and final groups were institutions with discretionary capital. And the last time that happened in Houston was probably at least 10 years ago. And so, the 6 of us sitting in our seats kind of thought things were really ramping up for Houston, kind of started to feel like 21 and 22 again with, buyer interest and, sales processes that continue to, blow through pricing guidance. Liberation Day kind of halted all that momentum. You can kind of see the VIX spike, and then it kind of came back down. 10-year ran up to about 4.5. Groups were kind of looking around, scratching their heads a little bit. And so we saw activity calm down quite a bit. And then throughout the summer, which is typically kind of a slower, sales time, for the Houston market, more so driven, everyone's, traveling, vacationing, and Houston's really not on the top of the radar for a place to visit when it's 100 degrees. And so we actually saw our pipeline, increase. I mentioned we have, quite a number of deals out that ranges from, a high rise to a foreclosure deal and everything in between. I think the deal I'm going to highlight that probably resonates most with you guys and the people on the call is a deal out in the energy corridor called Haven at Eldridge. We're working through best and final as we speak. So, some of that material is sensitive for now, but overall we did receive 30 offers on that deal. So that's 2015 vintage, 246 units, kind of a light value add, type of deal, so, we're seeing that capital, it's kind of your larger private groups and, kind of a mix of everyone, stacking up in there, from on the bid sheet. So, we're seeing groups kind of get risk on again. That's going to be trading in the low fives from a cap rate standpoint, and really feel like there's a lot of momentum for that 2000s and newer space. For the BC space, 70s and 80s construction, we're seeing anywhere from probably 10 to 15 bids, depending on the deal. So it's pretty obvious where capital attention is right now.
Got it. So just curious, I mean, that's a lot of bids. So which is great for you guys, great for the seller and all that, but is there any particulars at the location, or what do you think is drawing the interest on that particular deal?
Yeah, part of it is location. Energy Corridor has a good story. There's no new construction. You're not going to competing with a bunch of lease ups and concessions that typically come with deals in lease up. The Energy Corridor has had over the past 24 months one of the stronger office leasing and submarkets in the country. A lot of energy companies and similar groups have kind of moved west with with kind of where the population is, the center of Houston is moving to. So, it's a strong deal. But I think the big thing to keep in mind is it's 2015 construction with light value add. So it's not super capital intensive. This is exactly what a lot of the capital wants. And so we're seeing a bunch of overlap with the groups. Let's say, you guys, that's kind of been your strategy all along, versus the guys that were previously buying 70s and 80s construction. Now they're saying we want to go buy 2000s and newer, and so they're just piling into that space as well. And so it's starting to create a pretty competitive field for assets with that profile.
Yeah, that's super interesting. Cutt, I know you had kind of alluded to more borrowers are starting to shift back into that floating space. I'd be curious, is that a function of, maybe to Kyle's point, you guys are seeing a lot of offers, it's getting more competitive, or maybe it's just, for every, stabilized deal you come out with, you've got two that are unstabilized or some sort of distress component to it, and out of necessity, you're having to go that
Sure.
route?
No, yeah, that's a great question. I think, there's definitely some combination of both and all of that. And then I do think you're starting to see uh, probably, and at least in some of the institutions that we're seeing these requests from, is there's a belief that we're going to see a drop in rates sometime over the next 24 months where those floating rates start to make a lot more sense. The bridge loans are pricing fairly competitively right now, depending on the sponsor, depending on the deal, location, things of that nature. We're seeing pricing as low as 150 from some of the larger money center banks. And then as we start to gravitate towards the life insurance companies with more of a debt fund execution, quasi balance sheet execution, that's going to price somewhere in the neighborhood of 170-ish. And then as we move into more traditional debt funds, that pricing becomes very dynamic and wide, whereas we're seeing pricing anywhere between 225 and 325. So it's really more situational. I think it encompasses a lot of those different items we just discussed. But the bridge lenders are out looking for business too. They're always pinging us, several times per week. What do you have? What can we look at? So they're definitely hungry to get that business done.
Got it. And just for people on the call that may not know or understand, when you talk about spread, what are you
Yep.
talking about there? And then what does that look like for like an all-in rate for some of those various products?
Yeah, for sure. So whenever we're talking about the various debt funds and bridge lenders, they're going to price over an index called SOFR. That spread, the basis points will be the actual price of the loan that is indexed over SOFR. So if you have, say, if your spread's 200 basis points over today, you're somewhere in the neighborhood of around, low 600s on total coupon.
Got it. And Kyle, kind of hopping back over to you a little bit. What are you seeing as far as apartment supply and all that over the next few years in Houston?
Houston, Houston, I would say probably the best supply, or I guess lack of supply story, um, moving forward from the Sun Belt markets. Our peak supply was Q2 of last year, so roughly 12 or 13 months ago. You look at Dallas and Austin, they're just now peaking and trying to, continue to absorb all the new supply that's gotten built in this last construction cycle over the past couple of years. And so what that does is, the third party reports pick up on that and pick up as Houston as one of the first markets to bounce back and show real rent growth. When Houston is on the radar for, for market rent growth, that is what the institutions look for, and that's when kind of the larger capital starts turning their attention, because that's how they have to invest their money is based on third party reports, typically. A couple good stats for you guys. Year to date in Houston, we've had 7,100 units delivered. And year to date on absorption, we've absorbed 14,000 units. So we're absorbing more than we're building, and that trend is likely going to continue, and really what's going to drive the rent growth just across the market. And so I, from an investor, as a broker, I think we're all seeing the fundamentals in Houston align towards a really strong runway, because as Cutt will allude to, the development really doesn't make sense in this capital markets environment. Where rates are, it's near impossible to find equity. And so, we're going to have this lag of construction starts. And during that lag, we're going to continue to absorb more than we, deliver. And that's just a function of rent growth. So, good question, Dustin. Something we get hit with a lot in Houston, because we, typically do not have zoning. A few areas, a few submarkets of town does, but generally speaking, we can build units when the spigot's on. But right now and for the foreseeable future, I think we're in a really, really strong spot.
Yeah, we agree. We love Houston. Obviously, we've been building our portfolio here. And just for perspective for everybody too, those delivery figures that Kyle had touched on are probably about half of what the deliveries were last year. So we're already well into that sharp fall off. So it gets us excited for sure. Cutt, I got another question for you too, just with how deals are getting capitalized nowadays. Obviously, preferred equity is some people may have a love-hate relationship with it. It's kind of like candy. If you have too much, it could cause issues. But trying to, it could also be a great tool to your tool belt.
Yeah,
So,
no doubt.
No
doubt. I think pref equity has a love-hate relationship with themselves as well. But anyway, we don't have to get into that. But to your point, I mean, look, there's a lot of pref equity, trying to figure out how they fit into this, deal profile, right? It's the biggest struggle is that for some smaller deals, that's where it gets really tough. The pref equity really likes to be over that $5 million minimum. So we have a lot of groups that are consistently reaching out to us, needing these smaller pieces for much smaller deals, and it's really just it's a tough ask. Albeit there is some private capital out there that is willing to take a look at some of that. I would say, for a majority of the acquisitions that we're working on right now, the sponsors are either money good, via discretionary capital, or I would say a fund that's already in place, or they have a 1031 that's going to be coming into the transaction. We're working on one right now where a buyer, or I should say borrower that we know very well, they're selling an asset. They're going to start looking to, and they're going to have $10 million of ups to put into another transaction. So they're going to be very well received when it comes to best and final offers on any deal that they're going to bid on. I think, the biggest chore now is really just trying to, figure out, of the buyer pool is who is truly, money good on the equity. It's difficult, right? I mean, even, and I did indicate that, we're seeing some improvement in the retail syndication space, but it's, all it takes is one headline. And then all of a sudden, right, we have a major chore in front of us, and then it's really a different animal. And that's when more or less we start to see more requests for preferred equity. So, everything usually, intends to start out as a common equity type request, and that can evolve into pref equity, to my previous point, when we're in this uncertain environment. And that, I would say, any of these equity options are typically going to be coupled with 5-year fixed rate agency debt, and I would say, some type of debt fund execution as a second place.
And Cut, I guess to kind of follow up, how active are you seeing JV equity, or what does that kind of look like in the space right now?
As far as groups that are bringing in common equity,
Yep.
it's going to be, it'll be a combination of either, I would say, third party equity. Most groups now are going to be, I would say, the third party equity providers. They're going to provide anywhere between 80 to 90% of the total equity. And they'll expect those sponsors to be contributing, obviously, the balance of that. All of them are going to have a different profile as far as, what that equity is going to cost. We're pretty active in the recap space right now. We're seeing a lot of those deals. But, for some of these deals that really need the recaps, I mean, it's not the cheapest form of equity out there. And then it really starts to gravitate into, probably to, it never fails when we go out on an equity assignment, attempting to procure term sheets. As soon as we have a little volatility in the market, the response is, well, we're really not comfortable with, common equity right now, but we'd really like to give you preferred equity.
Yeah, makes sense. Yeah, have you seen Cut just on that? You kind of talked about a little bit on that pricing depending on the need.
Yeah.
Really, have you seen that pricing come in as these groups want to compete for the business?
Sure.
Because I know
Yeah.
kind of prior, I mean, we did a deal back in late 2020, early 21, where it was a 12% all in for a pref piece. So where has that gone over the last few years?
It really, we've seen it come in a little bit of late. I can tell you that for preferred equity, that I feel like most current pays that we're seeing right now are anywhere between kind of 6 to 9, and I would say maybe 12 to probably 15% on the accrue right now. And there's so many things, there's so many factors of that, right? It's what does the debt look like, right? I would say sophistication of the sponsorship. It's multifaceted, much like the debt, and what we're seeing from general debt terms that are available to most sponsors. So it's a bit of a moving target, and for my earlier comment, we're always at, much like the debt funds, the pref guys are always calling, trying to figure out where they can play, but it's a different story once you really put the deal in front of them, and just seeing if they're going to be able to execute and how much and things of that nature. Um, on the pref equity, I can tell you that most of these groups that are reaching out to us, they really prefer to be aligned with the agencies, and specifically with Freddie Mac in this environment. Freddie Mac tends to be a little more lax on their preferred equity guidelines. Fannie is okay, but I just feel like most of these groups are getting traction with Freddie Mac in this environment, and that seems to be the preference right now.
Kyle, are you seeing permit starts? Are there, we talked about supplies falling off a cliff. Are you seeing a bunch of people starting to try to build right now, or what does that space look like?
Yeah, we are starting to see that. It's hard to really kind of quantify it quite yet. But I'd say Houston's probably a top 5 market for permits in the Sun Belt right now. It's still early. It's still hard to put a deal together and go pull a permit. But to answer your question, yes, we are starting to think groups are kind of seeing the gap in the pipeline and trying to go take advantage of that. Be kind of one of the first ones out. So more, kind of private, type of groups, not as much with the kind of the larger institutional, types that probably have to see a little bit more of the writing on the wall before they jump back in, but we are seeing that.
Gotcha. Yeah. And then Kyle, I got a follow-up question too. We touched on it a little bit, but would love to go into more detail about like what does it take to win a deal nowadays? Like how important is that track record, that certainty of execution? Are you seeing newer groups able to break in that space? And if so, how? Kind of what does that landscape look like from your seat and from buyers or sellers' perspectives?
Yeah, good question. It's a timely question because we're going to be working through that on Haven to a degree, but we are really vetting the equity story with most groups. There's groups with a track record that speaks high volumes. That definitely helps us. It helps the seller get comfortable with the groups that have transacted in all different types of the market, market environments. But track record, we want equity on the phone, is equity in tow. We really are getting down to is the cap stack pretty much there before we even go start working on a PSA. So we're not seeing as much really hard money right now, a little bit, at non-refundable at PSA execution. But that's a little less important to these sellers right now. They really just want to know, like, can this person execute? Is the equity there? If not, what is their typical process, and have they done this, before? So that's a good question. New groups can break in all the time, but if you're buttoned up, have your underwriting, drilled down, have an insurance quote, a good answer on taxes and a buyer interview call, all different things, you guys are used to providing. But those are all the little things right now are getting looked at under a microscope when we pick a buyer for a deal.
Hmm. Yeah, makes sense. Obviously, the last few years have been challenging for everybody, I think. But it sounds like too, just a follow-up question to that. It sounds like the story, the complete picture is what's most important nowadays. So are you seeing that being the deciding factor in a seller's mind, or is price still kind of up there? Obviously, you got to be in the ballpark, but is maybe the second or third highest price winning because they've got a more complete story?
Yeah, uh, good question. That's deal to deal. We are working on some transactions right now where there is a looming debt maturity, and they're also out of the money. So, how much are you going to go chase last dollar when you have a limited time and probably can't afford a false start? So you start to have a balance and a lot of back and forth that goes into ultimately selecting a buyer and you moving forward. Um, the groups that have some time that, are, maybe bought in the last few years, that they'll be, taking a little bit of a haircut on the equity side. You see those kind of looking more towards the last dollar, trying to recoup as much equity as possible. But it just kind of comes back to, can this group get it done? a fully vetted buyer interview call, most times getting the equity partner on the phone. So it's a little, it's deal to deal for sure. Every situation is a little different right now. We have, a workforce portfolio we're selling right now of 4 assets. The owner has owned the assets since 2009, so 16 years or so. So, they have a low maturity, but totally different situation for them. It's just been a long-term hold for them, and now they're recycling the cash. And so, um, they will probably be more execution driven than last dollar. So it really just varies.
Sounds good. And Kyle, I guess a little selfishly, but what sort of kind of in that A minus space, 2000s and newer for the most part, what sort of price per door, range are you seeing for that? Obviously, it depends on the area and all that, but what sort of range are you seeing on that product?
Yeah, I'd say kind of. I'll just give you live examples. 2016 Haven and Eldridge, pricing is in the 160s, somewhere in there. You know, I won't give you the full details, and I can at a later date, but we're kind of 160 to 170 on that deal. And then, we just launched Kessler Jersey Village. That's a 1995 construction, 145 to 150. And then some of the, newer stuff is pushing closer to 200 a door. So, you know, A minus kind of 2010 plus or minus construction, suburban, 3-story walk up type of product, you're probably looking somewhere between 150 to 170. Is probably a good kind of put your finger in the air and paint it with a broad brush.
Gotcha. Yeah, sounds good. Cut, I've got a follow-up question for you. I know you touched on, how buyers are capitalizing deals nowadays. And when you're talking about floating rate debt, obviously you got to talk about rate caps too. And,
Yeah.
we might be at this, flexion point where, like you said, it might make more sense to do floating than fixed in certain groups' minds. But then there's that whole other question of, okay, well, where do you cap that loan at? Do you do a higher strike? Caps are still kind of expensive nowadays. I remember
They
back in the
are.
days when they were cheap, we were buying as much of an in the money cap as we could.
Right.
But maybe that doesn't make sense right now because if you expect rates to drop, maybe you want a higher strike to spend
That's
less
right.
money.
And you just pretty much answered it. I mean, I think, for the floating rate deals that we're working on, they're trying to, to buy the highest strike that they can, right? And obviously price has a lot to do with that. But but if we have firm belief in that those rates are probably going to be kind of maintained and coming down, hopefully that just really, doesn't come into play. I guess what we're, and another interesting thing on interest rate caps, whenever we have these situations where a potential refinance comes in, a big exercise that we seem to be running is just getting a firm the agencies. And once we understand that dollar amount, the agencies afford us the opportunity to buy down the rate, right? So, for instance, on a Freddie 5-year deal for 2% of the loan amount, we can buy down the rate 38 basis points. So how does that cost look compared? And keep in mind that you're going to be going in for another 5-year fixed rate vehicle. How does that cost compare to my new interest rate cap, right? I mean, it's basically a sunk cost. And I think a good case study on that is that we had a sponsor that said, in order for this new loan to make sense for us, we got to buy down the max, right? So it's going to cost us, however much money. But, the lender was willing to work with us on our rate cap, and it's going to be much cheaper to buy the rate cap. And then we'll be in position to sell in 12. Makes sense. I get it. but that's not always the case. I mean, all it takes is for, 1 week of extreme volatility, and these rate cap prices, as we all know, they can fluctuate day to day, week to week. And it just, it's something that you got to be very cognizant of, and obviously have a good handle on to make sure that you're executing in the right environment for the cheapest gap possible. So, but I do, yeah, from what we're seeing right now, for the deals that are going float, most sponsors are electing to take, the cheapest option possible because of the expected rate environment that we should be moving into. Hopefully, sometime very soon.
Yeah, wish it would have been, wish the rates were already lower now,
Yeah,
but
I know. I get it.
but anyways, it was nice. We had a nice, drop of the treasuries not a day or two
Yep.
ago. But uh, Cut, kind of going back, following up the question asked Kyle about a new build. The
Yep.
permits are starting to kick up a little bit. Are developers able to fund these deals? Like, what
No,
does the equity look
no,
like
no.
on that front?
The equity is the biggest struggle for these guys. We continue to get multiple calls on what does the equity look like for development. Um, I had a stretch senior lender call me the other day. They're doing ground up construction, and they were looking at this one deal, and they had a pretty, they said, look, we got the debt package, but we can confirm that they don't have the equity yet, right? So I think a lot of guys, to Kyle's point, are really just testing the water right now. um, we're seeing some, we've got a big deal in Providence, Rhode Island, that we're trying to capitalize right now. The equity's been a big struggle on that one. Got several deals in Texas that have kind of been just matriculating, and we could, and the way we're typically getting engaged on those is for an extended period, and we'll monitor the equity markets. If something comes to light, we'll bring it to that sponsor and, see if we can't have a discussion from there. And but it's really a struggle right now. There are some isolated cases in certain markets that have a pretty good supply story, where you might have a family office team up with, say, an acquaintance who is a developer, right? And those deals are getting capitalized. The bank financing's there for it, uh, albeit it's going to be for a repeat developer borrower, and there's going to be recourse attached to it. So it's not necessarily the most attractive debt option, but I think we can all agree, if you can get a shovel in the ground right now, it's a pretty dang good time to get those deals rolling. So I get it. I think, pulling permits and testing the waters, I think it makes sense from a development standpoint, but the capitalization side of it, specifically the equity, it's pretty tough right now.
Yeah, yeah, absolutely. Kyle, kind of follow up to that. So for developers that are getting permits but having trouble with equity, are they are they going to buy deals? Are they just waiting for the equity to kind of matriculate, or are they just on the sidelines? What does it look like for developers?
Yeah, yeah. Some developers are turning to buyers over the past 24 months. We definitely are seeing that. I will say they typically aren't winning deals. We're not finding them at the top of bid sheets, but they are touring. They are participating in bid processes. Some of the newer construction, that's pricing, let's call it below today's replacement cost, but in their developer brains, it's still above replacement cost. They just struggle getting over that hump. So they're, typically not competitive on those deals, but, we are seeing that, but they're not really, they're not transacting, if that makes sense. I think, it might be more for data points for them. We've seen, but outside of that, we're really not seeing, um, a lot of developers, at least in Houston, become prolific on the buy side right now through this.
Yeah,
And I
that's
think,
interesting.
kind of just, even further that point, whenever, you have a potential equity source, they see, the cost to develop right now, which is by no means cheap. And that's when that replacement cost story really starts to come into effect. And, if you're able to buy, early, 2020s type vintage asset and, the replacement cost makes sense, it's, why would I not play there? Right.
Yeah, absolutely. Makes a lot of sense. So I've got a question for both you guys. Obviously we've worked with you guys for a number of years now, and again, these last few years I think have been challenging from everybody's seat. And so, curious just from what you've learned and experienced with different buyers and sellers. Cut, I'll start with you. Are there any things that you've picked up along the way that maybe makes you not want to work with a group?
Yeah, I think, after navigating environments like that we're hopefully coming out of right now, you learn who the good guys are and who the bad guys are. And obviously, fraud is at the forefront of every capital source out there. They're very sensitive to it. So we do spend a lot of time vetting, and in our Monday morning meetings, we'll have a request for debt or equity come in. So, one of the first questions is, is this a group we want to spend time with? And, and if there's any really just absolute negative press out there, we're going to try to, respectfully, decline that request and, give them some guidance on maybe some capital sources that it's I think a lot of groups tend to show their true colors after navigating this kind of environment. So we're very astute to that, and we spend a lot of time vetting potential borrowers on our side, and it's a direct reflection of just how all the lenders are, quite frankly, are looking at these groups. I can tell you that borrower credit tenor at the capital source level is pretty tight right now. Unfortunately, a lot of our best lending relationships have had some exposure to some of this bad stuff, and they are very much going to dig into every facet of that borrower's equity. If it's a new preferred equity source they're bringing in, they want to understand that preferred equity. What is the source of funds? Circling back to the borrower, well, proof of liquidity. We want to see actual bank statements, not a screenshot. It's just, it goes on and on and on. And we have to really keep our young guys. We got to keep them positive because they're slugging through a lot of this stuff, and they've never seen anything like this. We went from blowing and going, and everything was easy to now it's pretty difficult and strenuous and very grindy on every deal. But I think it's warranted because of some of the fraud exposure that we've seen.
How about you, Kyle, on the especially since you're kind of in the middle of the buyer and seller? So, is there anything that you've learned along the way?
Yeah, probably just to piggyback on what Cutt said, transparency. 21, 22, there wasn't much of that because it kind of wasn't needed. I mean, deals were put together so quickly, so easily, that you just knew the second you got something under contract in 60 days it was going to close. And the reality is that's not, the case anymore. And you have to make sure that everyone's being truthful, like, hey, we have the equity or we don't have the equity. If we don't, then how are we raising it? Have we done this before? Kind of what I was saying previously. And so I think just transparency on both sides, kind of helps everyone involved and not, avoid false starts and avoid wasting time, on certain transactions. So, that just makes for a lot more upfront questioning from, on our side. And I'm sure, Cutt does the same on his. But I think just kind of having some, transparency and good communication that, it just sets expectations from the start is helpful today.
Got it. We had a question from the audience. This, I guess, I don't know, maybe for both you guys, but when you guys are, potential have a seller that you're going to represent them and sell their property. Is there anything, and some of it's just very difficult because you're wanting to trust the seller and all that their financials are what they say they are. But I guess, anything that you guys can think of that to help kind of vet the sellers, that make sure their financials are what they, are where they say they are, and all that.
There's only so much we can do in our seat. I'd say 9 times out of 10, the financials are coming from a reputable third-party management company. It's just really, and so, um, I we don't typically see a bunch of fraud or any of that. I know some of it's been kind of headlined as things kind of unravel from 21 and 22 still, but from us trying to vet out a seller and what they send us to review for a BOV or go to the market and sell their asset, it's kind of hard to really fully vet. We really don't come across that quite a bit.
Yeah. Yeah. Gotcha.
Well, cool. And then we had another question come in from Richard asking about thoughts on the HFC and PFCs the past few years. I know there's been a lot of challenges, changes. It's very gray, but maybe, what you guys think of it and where you guys maybe think it's headed.
Yeah, I can
Yeah,
go ahead, Kyle. I've got some thoughts, but go ahead.
Okay. I think it's pretty gray right now. HB 21 threw a curveball in there. And now there's talks of a special session, with, possible other changes, with, 303, 392 and 394. So, we'll see. I think, a lot of these deals are, we're looking at a number of them that are looking and would like to transact, but I think they're waiting for a little bit more of a clearer picture and buyers to kind of come back to the table, and capital to be comfortable with those structures moving forward. There is a market for them. There are buyers that are willing to, take that risk, and look at buying those. But I would say groups that previously told us that they want to buy HFC or PFC assets, some of them have kind of gone to the sidelines for those structures in the meantime, just wanting to make sure they fully understand, what changes are on the table and possible. So, apologies, I don't have a more direct answer for you, but I think everyone's still kind of waiting to see what happens in Austin.
I think, yeah, those are all spot on, Kyle. And I can tell you that, from a lending perspective, it's very dynamic, right? I mean, Dustin, Hayden, we have these discussions often. As it relates to the traveling 394, specifically a traveling HFC, I can't think of a lender out there that would even touch one. Most of the sponsors that we know, and they were pursuing this avenue, they quickly pivoted away from that as soon as HB 21 hit the table, and they're looking at other solutions to try and get those assets capitalized. As it relates to agency financing, they have a pulse on this, just like everybody else does. Fannie's really never been that competitive in the space, even when everything was, I would say pre-HB 21. But Freddie, at this current stage, we're still able to process, I would say, your standard jurisdictional 392 that will go through targeted affordable housing. That's where we're going to see all the bells and whistles for multiple years of interest only. Really see the pricing get driven down, and in some cases, we get the 35-year amortizations, whereas 303s are going to be, and 394s are going to be processed through the respective region, meaning, any deal in Texas would go through Freddie's central region. And it's going to be much more restrictive terms as it relates to target affordable housing at, say, Freddie Mac. And I can tell you that they're going to underwrite taxes on every 394 that's jurisdictional. And then 303s, the narrative initially was, we're good to not underwrite taxes, but now they're handling each one of those on a case by case basis. And some of the borrower solutions that we've seen is that they will offer up, some type of deep escrow to try and offset that. CMBS lenders that are willing to play in this space, they're going to, I guess there's always that difference between, once the HFC has been done, the timing between the HFC closing and when that actual tax benefit is realized on the tax, there's going to be a recourse component attached for that time period to make sure that tax abatement is going to be realized by the taxing authority. So it's very much a moving target. Who knows where this ends up, but I think, just to speak from from an appraisal standpoint, most appraisers are still looking at these as, hey, they're going to get the tax abatement. We're going to cap it, with market cap rate and kind of move from there. We're not seeing any, giant moves in cap rate to handicap these deals just yet. So, does that change at some point? I'm sure it does. But as we sit here today, things are pretty good from the appraisal side. I think as it relates to, potential buyers, and Kyle, you can speak to this better than I can. I do think that there is definitely some handicapping going on in that space as it relates to cap rate because of just the general uncertainty. It is a dynamic animal right now, and who's to say where we end up? But I can definitely, appreciate the question because everybody's trying to figure it out right.
Sounds good. Well, yeah, we'll go ahead and get this wrapped up. Really appreciate both of you guys and appreciate you guys being on. If you guys, I don't know if you want to give out any info for you guys or whatever, but anyway, anyone on here, these guys are, if you looking to sell multifamily in Houston, looking to buy multifamily. These guys know everything there is about Houston, and then if you're just looking to finance, any sort of multifamily, Cutt can help you no matter where you are in the country. So appreciate you guys. If you want to give any contact info or just
Dustin, first of all, thank you for that. We truly do appreciate it. And look, it doesn't have to be about a deal, right? If you have general questions or, you're looking for market knowledge, please consider us as a resource. We have a lot of tools available and we can get, most of that information over to you quickly. So we're here to help in any capacity. We're not only, in the brokerage business, obviously, but, we're in the fee sharing business as well. And I think it's important for everybody to be armed with much information as possible. So
thanks for having us on. I put my email in the chat in case anyone has any follow-up questions. Happy to share or schedule a follow-up call.
Sounds great, guys. Well, appreciate you guys have a great Wednesday, and I'm sure we'll talk to you here in the next day or two. So thanks, guys.
All right. You bet. Thank you.
Take care.
Thank you, guys.
Bye.
Bye.